Something shifted after that 97.94 rejection on the dollar, and most traders still haven't seen it. Gold is standing at $5,000, refusing to fall. USD JPY is pulling the entire currency market with it, and one key level on the yen could decide what happens in the next 48 hours. If that level breaks, it won't just move one pair. It could trigger a chain reaction across gold, EURR USD, and GBP USD. There's a triangle forming on gold, a pressure zone building in USD JPY, and a decision window that is closing fast. The real question is not if volatility returns, but who will be positioned when it does. Stay with me, because the next move could surprise almost everyone. Welcome to Market Metal. If you're someone who has seen a few market cycles in your lifetime, someone who understands patience and timing, then gently tap that subscribe button like you're bookmarking wisdom for the next chapter ahead. And tell me, where are you watching from today? Which country? Which city? I'd love to know who's here with us as this story unfolds. The dollar's inflection point when momentum meets resistance. The week began with confidence in the US dollar. In the days leading up to the most recent policy decision, momentum had clearly shifted in favor of USD strength. Treasury commentary had supported the idea that the dollar could remain firm, and capital had followed that narrative. The dollar index climbed steadily, recovering from prior weakness and building the appearance of control. But markets rarely move in straight lines for long. By the time the dollar index approached 97.94, a Fibonacci retracement level closely monitored by institutional traders, the tone began to change. That number was not random. It represented a technical barrier derived from prior swing structure, a level that often attracts large decision-making. For professional traders, such levels are not merely lines on a chart. They represent areas where positioning must be reassessed. At 97.94, buyers hesitated. Momentum slowed, the rally stalled. This was not dramatic. There was no headline crisis. There was no panic. Instead, there was something more subtle and more important, a loss of acceleration. The dollar, which had been riding a wave of recovery, suddenly met resistance strong enough to stop it. For experienced observers, this type of behavior is often the first signal that underlying capital flows may be shifting. When a currency fails at a major resistance level, it raises a serious question. Was the rally driven by conviction, or was it driven by positioning that has now run its course? Businesses, especially those operating across borders, cannot afford to ignore such inflection points. A strong dollar tightens global financial conditions. It increases costs for borrowers outside the United States who hold dollar-denominated debt. It pressures commodity prices. It changes pricing dynamics for importers and exporters. When the dollar strengthens, it is rarely just an FX story. It becomes a global liquidity story. The recent rejection at 97.94 suggests that the recovery phase may not have been as stable as it appeared. In financial markets, failed breakouts often carry more meaning than successful rallies. When buyers cannot push price beyond a known resistance level, it often signals exhaustion. After the rejection, sellers began to reappear. The shift was not violent, but it was steady. Each attempt to reclaim the prior highs faded. The bullish wave that had carried the dollar into resistance lost rhythm. Momentum indicators flattened. Participation narrowed. For decision makers in business, this kind of transition period is critical. It marks the difference between trend continuation and structural change. If the dollar were to resume strength and break above resistance, the message would be clear. Financial tightening continues. But if the rejection holds and price rotates lower, it could signal a broader adjustment in global risk appetite. Behind the surface level price action, deeper forces may be at work. The dollar's rally had been partially supported by expectations surrounding interest rates and forward guidance. When such expectations become fully priced in, the market often pauses. Investors who positioned early may begin to take profits. Late buyers may find themselves trapped. At the 97.94 level, it appears that at least some large participants chose caution. This is not speculation, it is structural interpretation. Major technical resistance often aligns with areas where institutional orders cluster. Hedge funds, asset managers, and multinational corporations hedge currency exposure near such zones. If demand fails to overwhelm supply at that price, the path of least resistance shifts. The implications stretch beyond currency desks. Consider a multinational manufacturer importing raw materials priced in dollars. A strengthening dollar increases input costs for foreign buyers. Now imagine that the dollar stalls and weakens. Instead, pricing forecasts must be adjusted. Hedging strategies must be reconsidered. Even small percentage shifts in currency valuation can alter quarterly earnings projections. For young entrepreneurs and business leaders watching global conditions, this is not academic. Currency stability influences supply chains, capital expenditure timing, and cross-border investment flows. The dollar's rejection at resistance introduces uncertainty. Uncertainty in markets is rarely neutral. It often precedes volatility. What makes this situation particularly important is the speed of the prior move. The dollar did not drift into resistance slowly, it rallied with purpose. Such rallies, when stopped abruptly, can lead to equally purposeful reversals. Observers must now ask a more strategic question. If the dollar is not extending higher, what is driving the shift? The answer begins with USD JPY. The Japanese yen holds a significant weighting in the dollar index basket. Its influence is not marginal, it is material. When USD JPY moves sharply, it can distort or amplify the broader dollar narrative. In recent sessions, weakness in USD JPY began to pressure the dollar index from within. This dynamic reveals an important principle. Markets often change direction from the inside before the headline index reflects it. If USD JPY is unwinding due to carry trade repositioning or political shifts in Japan, then the dollar's rejection at resistance may not be isolated. It may be part of a wider repricing of global leverage. Carry trades, where investors borrow in low-yield currencies like the yen and invest in higher-yield assets, create embedded leverage. When such trades unwind, the process can be swift. Funding currencies strengthen, risk assets wobble, liquidity tightens. In previous cycles, similar conditions led to sharp currency adjustments that spilled into equity and commodity markets. The rejection at 97.94 may therefore represent more than a simple technical stall. It may be the first visible sign that capital is repositioning ahead of new information. Business leaders should not interpret this as alarmist. It is not a crisis signal. It is a caution signal. Markets communicate in stages. First, momentum slows, then key levels are tested, then participants reassess exposure. Only later does volatility expand. At present, the dollar stands between continuation and correction. The resistance held, buyers paused, sellers re-entered. The inflection point is real. For entrepreneurs and executives managing exposure, this is the moment to watch carefully, not react impulsively. If the dollar resumes strength, the rejection will prove temporary. But if weakness deepens, it could open the door to broader FX volatility across USD, GBP, USD, and precious metals. The week ahead is not about prediction, it is about preparation. The dollar reached a critical level. It hesitated. Now the market waits to see whether that hesitation becomes reversal or simply consolidation before another advance. The answer will likely begin with USD JPY. USD JPY, the pressure point beneath the dollar. While many observers focused on the dollar index itself, the more critical development was taking place quietly inside one currency pair. It was not dramatic at first. There were no headlines warning of instability. There were no emergency announcements. But beneath the surface, pressure was building in USD JPY. That pressure may prove decisive. The Japanese yen represents 13.6% of the dollar index basket. That number may appear modest, but in currency construction it is powerful. Because the US dollar sits in the numerator of the USD JPY quote, shifts in this pair can influence broader dollar sentiment in ways that are not immediately obvious to casual observers. When USD JPY trends higher, it supports the dollar narrative. When it turns lower, it can weaken the dollar from within. Over the past cycle, USD JPY had remained elevated compared to the broader dollar index. That divergence reflected something deeper than simple technical movement. It reflected structure. For years, global investors borrowed cheaply in yen and invested in higher-yielding assets elsewhere. This strategy, known as the carry trade, created a built-in long bias in USD JPY. As long as interest rate differentials remained wide and volatility stayed contained, the trade worked, capital flowed outward, leverage accumulated quietly. But leverage never disappears, it waits. When the dollar rallied recently, USD JPY followed, reinforcing confidence in the move. Yet, as the dollar reached resistance at 97.94 and stalled, USD JPY began to soften. That softness may not be random. It may reflect early signs of carry repositioning. The critical zone now sits between 154.45 and 155. This area is not merely a technical marker. It once served as resistance before being converted into support. Such roll reversal levels carry weight. Institutional traders remember them. Hedging desks calculate around them. When price approaches such zones again, markets become sensitive. If support holds, it reinforces stability. If it breaks, it invites acceleration. The risk lies not in gradual decline, but in speed. Carry trades depend on calm conditions. When volatility rises, funding positions unwind quickly. Investors who borrowed in yen may rush to repay those borrowings. That process strengthens the yen sharply and pressures USD JPY downward. The unwind does not move in steps. It often moves in waves. History offers examples. In previous episodes of carry unwinding, USD JPY declines accelerated faster than fundamentals alone would justify. What began as technical weakness turned into leverage liquidation. This is where the strategic warning becomes relevant for business leaders. An abrupt USD JPY decline would not remain isolated to currency markets. It could tighten global liquidity conditions. It could pressure equities. It could shift commodity flows. Businesses exposed to cross-border financing would feel the ripple effects. Complicating the situation is the political layer. Japanese policymakers have previously signaled discomfort when USD JPY approaches the 160 Gurur level. Public statements about potential intervention are not idle commentary. They function as psychological guardrails. If markets test those guardrails, volatility increases. Recent political developments in Japan have added another variable. Election outcomes can alter expectations around fiscal and monetary coordination. Even subtle shifts in tone from the Ministry of Finance can influence speculative positioning. The market is therefore navigating a narrow corridor. On one side lies carry support, interest rate differentials that still favor holding USD JPY long. On the other side lies intervention risk and potential volatility expansion. Between them sits the 154.45, 155.00 zone, acting as a structural fulcrum. For professional participants, this is not a place to chase momentum blindly. It is a place to measure risk carefully. The challenge for USD bulls is structural. If USD JPY stabilizes and rebounds, it could re-anchor the dollar's broader recovery attempt. But if USD JPY continues descending, the dollar index may struggle to regain footing, even if other components remain steady. In this sense, USD JPY is functioning as the transmission channel. Currency markets rarely move in isolation. When one pair with embedded leverage begins to shift, others adjust. EUR-USD may strengthen not solely because of euro strength, but because of dollar weakness transmitted through yen dynamics. GBP-USD may find support not from domestic catalysts alone, but from broader USD repositioning. The interconnectedness matters. Young entrepreneurs watching macro trends may wonder how such currency mechanics affect real business. The answer is direct. A strengthening yen alters export competitiveness for Japanese firms. A weakening dollar influences commodity pricing globally. Rapid currency shifts affect investor sentiment, which influences capital allocation. Venture funding, private equity flows, and corporate debt issuance all respond to perceived currency stability. USD JPY is therefore not simply a trading instrument, it is a liquidity gauge. If it remains stable above support, markets may interpret the recent dollar stall as consolidation. If it breaks decisively below 154.45, it could signal that deeper repositioning is underway, and repositioning is rarely gentle. The risk is not only technical, but psychological. Markets often move the fastest when participants realize that others are exiting simultaneously. The awareness of leverage amplifies decision-making speed. For now, the zone holds. Price is testing it. Volume patterns suggest caution. Traders hesitate before committing. This hesitation reflects something important: uncertainty about the next macro driver. Interest rate policy remains a factor. Political signaling remains a factor. But positioning may be the dominant factor in the near term. When positioning drives markets, moves can exceed expectations. The dollar's stall at resistance opened the door. USD JPY now stands at that door's threshold. If the pair stabilizes, confidence may return. If it falters, the dollar's inflection point may evolve into a broader trend shift. Serious decision makers understand that such moments are not for prediction, they are for preparation. USD JPY is not merely moving, it is testing the foundation beneath the dollar. Whether that foundation holds will determine not only currency direction, but potentially the tone of global risk markets in the days ahead. Gold at $5,000. The quiet battle at a psychological frontier. While currency markets debated support and resistance, another market was staging a far more symbolic confrontation. Gold was not drifting quietly. It was pressing against $5,000. That number is not simply a price. It is a statement. Round numbers in financial markets act as psychological frontiers. They concentrate attention, they attract headlines, they force institutional participants to reassess conviction. When gold tests a level like $5,000, it is not only buyers and sellers meeting, it is confidence confronting doubt. The metal approached the threshold steadily, not violently. It was not a parabolic surge. Instead, it was a controlled advance marked by higher lows pressing into horizontal resistance near 5,100. Technically, this forms what analysts describe as an ascending triangle. Strategically, it represents compression. Compression builds energy. In such formations, buyers become increasingly willing to step in at higher prices, while sellers defend a fixed ceiling. Over time, the range narrows. The market begins to coil. When release comes, it is rarely minor. The critical question is not whether gold is strong, it is why. Traditionally, gold and the US dollar move inversely. When the dollar strengthens, gold often softens. When the dollar weakens, gold finds support. But recent sessions have introduced nuance. Even as the dollar hesitated at resistance, gold did not retreat meaningfully. It held ground near $5,000. That resilience carries implications. For institutional investors, gold functions as more than a commodity. It is a hedge against currency debasement, geopolitical uncertainty, and systemic risk. When price approaches a major psychological level and refuses to retreat, it suggests underlying demand. The $5,000 figure is therefore a test of belief. If buyers can defend it convincingly, the path toward 5,100 and possibly beyond remains open. If the level fails, the retreat could be sharp, as speculative participants exit quickly. Yet what makes this moment particularly compelling is timing. The dollar has stalled. USD JPY stands at structural support. Carry trade mechanics introduce volatility risk. Against that backdrop, gold presses upward. This convergence suggests something deeper than isolated technical movement. It suggests capital is reassessing exposure. In previous cycles, gold breakouts often preceded shifts in broader financial conditions. When investors lose confidence in fiat stability or fear tightening liquidity, they allocate toward tangible stores of value. Such behavior does not always produce immediate crisis, but it often signals caution. From a structural perspective, the 5,100 level functions as horizontal resistance. It has rejected advances multiple times. Each rejection reinforces its significance, yet each higher low increases pressure against it. This is not a random pattern. It reflects institutional behavior. Large asset managers rarely commit aggressively at obvious resistance. Instead, they accumulate gradually on pullbacks. The ascending pattern suggests that pullbacks are becoming shallower. Buyers are not waiting for deep discounts. They are stepping in earlier. That shift in behavior deserves attention. For business leaders, gold's movement is not abstract. Commodity strength influences inflation expectations. It affects input pricing. It alters central bank calculations. When gold rises aggressively, policymakers face more complex communication challenges. Entrepreneurs operating in manufacturing, energy, or technology may not trade gold directly, but they experience its impact indirectly. Rising metals often correlate with currency volatility. Currency volatility complicates global procurement and pricing models. The tension at $5,000, therefore, extends beyond traders. It reflects a broader evaluation of stability. If gold breaks decisively above 5,100, markets may interpret it as confirmation that confidence in fiat currencies is softening. That does not imply collapse. It implies repricing. Repricing changes capital flows. Investors may reduce exposure to risk assets. Bond yields may adjust. Currency hedging strategies may shift. Even if the move unfolds gradually, its implications ripple outward. Conversely, if gold fails at resistance and retreats sharply, it may signal that the recent bid was opportunistic rather than structural. That scenario would reinforce dollar stability and reduce immediate volatility concerns. At present, neither outcome is confirmed. Price remains compressed. Higher lows continue. The ceiling holds. Markets are waiting. The psychological intensity of such waiting periods should not be underestimated. Participants recognize the importance of the level. Volumes thin as uncertainty grows. Orders cluster just above and below resistance. When resolution arrives, it often surprises in magnitude. Gold's behavior also interacts with real yields. If bond markets begin adjusting to perceived economic shifts, gold's attractiveness relative to yield-bearing assets changes. Thus, what appears as a simple technical pattern may, in fact, reflect a broader macro recalibration. Observers should also consider correlation shifts. If gold strengthens while the dollar stabilizes, it may indicate independent drivers, perhaps geopolitical allocation or sovereign accumulation. If gold strengthens in tandem with dollar weakness, it reinforces traditional inverse dynamics. Either path carries meaning. What cannot be ignored is persistence. Gold has not collapsed under pressure. It has not abandoned $5,000 easily. Each test has been met with renewed buying interest. That resilience suggests conviction. Conviction in markets is powerful, but it can be fragile. If USD JPY breaks support and accelerates dollar weakness, gold could gain momentum rapidly. If the dollar reasserts strength, gold may struggle to hold gains. This is the crossroads. The triangle formation is not merely a chart pattern. It is a visual representation of tension between currency stability and monetary uncertainty. Serious decision makers do not react emotionally to such tension. They monitor it. They prepare scenarios. They understand that markets often reveal structural changes through subtle technical shifts before headlines confirm them. Gold is at a frontier. The battle at $5,000 is quiet, but it is consequential. If the ceiling gives way, it could mark the beginning of a new repricing phase across currencies and commodities. If it fails, it may restore confidence in the dollar's ability to stabilize. For now, the compression tightens, and compression in financial markets rarely lasts indefinitely. The euro, the pound, and the quiet repricing of the dollar. While attention remained fixed on the dollar and gold, another story was unfolding, less dramatic but equally revealing. The euro and the British pound were beginning to respond, not with chaos, not with panic, but with structure. EUR-USD had advanced steadily as the dollar softened. The move was measured, not impulsive. Each pullback was met with demand. The pair climbed toward a clearly defined resistance band between 1.1909 and 1.1919. This zone mattered. It represented a prior ceiling where sellers had previously asserted control. In institutional markets, such clusters often attract renewed supply. Traders who sold there before remember it. Algorithms recognize it. Corporate hedgers position around it. As price reached the zone, momentum slowed. There was no immediate breakout. Instead, the advance stalled. For more than a day, EUR-USD tested the area but failed to push decisively through it. This hesitation is not weakness. It is negotiation. Markets negotiate at key levels before committing capital. If buyers overcome resistance, continuation becomes likely. If sellers regain control, the move retraces. Below the market lies 1.1837, an area of prior resistance that may now serve as support. This role reversal principle is foundational in technical structure. When price breaks above a barrier and returns to test it from above, the reaction reveals conviction. If buyers defend the level, trend continuation strengthens. For business leaders exposed to euro-dollar pricing, such structure is practical, not theoretical. Exchange rate stability at these levels influenced procurement costs, revenue forecasts, and international investment decisions, but the euro is not acting alone. The British pound, often referred to as cable, experienced sharp volatility following the Bank of England meeting. Sellers initially pressed the pair downward, driving it toward a support zone previously identified as S2. Yet at that level, selling slowed. Buyers re-entered. Since then, GBP/USD has formed a short-term higher low followed by a higher high. In technical terms, that structure suggests potential trend reversal. And what makes this development significant is timing. As the dollar hesitates and USD/JPY tests support, both EUR-USD and GBP/USD show constructive formations. That alignment cannot be dismissed. Currency markets are interconnected. When multiple major pairs reflect dollar weakness simultaneously, the probability increases that broader repositioning is underway. Yet caution remains essential. EUR-USD faces the psychological gravity of 1.2000. Round numbers attract attention much like gold's $5,000 threshold. Even if price clears immediate resistance, continuation may encounter hesitation near that figure. Similarly, GBP/USD may offer cleaner upside structure, but it remains sensitive to central bank guidance and domestic economic signals. The deeper signal lies in the cross pairs, GBP/JPY and EUR/JPY. GBP/JPY previously rebounded sharply from the 210 zone after a carry unwind episode. That rebound led to an 18-year high, underscoring the power of leverage dynamics. Now, as price peels back toward that same 210 area, the market faces a test. If 210 holds, it reinforces resilience. If it breaks, it may indicate renewed carry stress. EUR/JPY presents a slightly different tone. Rather than forming a fresh high, it printed a lower high followed by a sizable sell-off. The daily structure resembles what technicians describe as an evening star, a formation that often signals potential reversal. Support sits between 182.65 and 183.16, with the 182 Azure level just below acting as secondary defense. The divergence between GBP/JPY and EUR/JPY is not trivial. When cross pairs diverge, it often reflects selective capital flow rather than broad-based conviction. Such selectivity can precede volatility. From a strategic standpoint, the dollar's next move may not originate from EUR/USD or GBP/USD directly. It may originate from USD/JPY. The yen's leverage influence continues to function as the transmission mechanism. If USD/JPY stabilizes and rebounds from support, EUR/USD and GBP/USD may struggle to extend gains. If USD/JPY breaks lower decisively, dollar weakness could accelerate, allowing euro and pound to push beyond resistance zones. This interdependence underscores a larger theme. Markets are currently compressed across multiple fronts. Gold compresses beneath 5,100, USD/JPY compresses above 154.45. EUR/USD compresses beneath 1.1918. GBP/JPY compresses near 210. Compression across markets rarely remains quiet. For business executives and entrepreneurs, the significance lies not in daily fluctuations, but in structural risk. Currency volatility influences cost structures, cross-border deals, and capital allocation. When multiple major FX pairs approach critical technical zones simultaneously, the probability of expanded movement increases. Such expansions do not always align with news. Often they reflect positioning shifts. Positioning shifts affect liquidity. Liquidity affects credit conditions. Credit conditions affect business expansion and investment appetite. The current environment resembles a coiled spring. Each pair approaches decision points. Each resistance or support zone serves as a potential catalyst. If resistance breaks across EURR USD and GBPK USD, while USD JPY weakens further, the dollar index may enter a corrective phase. That correction could alter commodity pricing and investor sentiment. If, however, USD JPY stabilizes and gold fails at resistance, while EUR.USD retreats from 1.1919, the dollar may regain strength, reinforcing financial tightening conditions. Neither scenario is confirmed. Both remain viable. What distinguishes this moment is synchronization. When gold, the dollar, and major FX pairs all approach structural thresholds at once, markets signal that equilibrium is fragile. Fragility does not imply collapse. It implies sensitivity. Serious decision makers understand that sensitivity demands preparation. Hedging strategies may need adjustment. Cash flow projections may require flexibility. Exposure assumptions must be stress tested. The final outcome will not be determined by one chart alone. It will emerge from interaction among all of them. The dollar's stall was the first signal. USD JPY became the pressure point. Gold revealed the psychological frontier. Now the euro and pound complete the picture. Markets stand at coordinated inflection. The next decisive break, whether upward or downward, may not remain confined to currency screens. It could reshape expectations across commodities, equities, and global capital flows. The quiet repricing is underway. Whether it becomes acceleration or stabilization depends on which levels hold and which give way.